It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. I'm your host. I'm also one of the CFPs on the program. And with me, as always, in the KFG studios, my business partners, but more importantly, fellow CFPs, Kevin Korhorn and Josh Gregory.
And friends. And Mike, that...
less important.
That mentoring on the big radio voice is really paying off. I'm proud of that. So my question is, what are the biggest surprises you're likely to face in retirement? And we have helped thousands of people retire over the years and help them to understand what to experience. We want to help you anticipate what to expect so that you can plan even better. And we're leading off with that topic today on the Wise Money Show.
That's right. If you have a question for the program, we'd love to hear from you. We'd love to help as well if we can. Reach out to us, 574-222-2000. That's call or text 574-222-2000. Online, wisemoneyshow.com. You can stay up to date on all Wise Money content and then find out more about us as well. And then all over social media, just search the Wise Money Show. Follow us there. All right, so I was on some social media recently, YouTube, just goofing around. It's probably 2 a.m., something like that. That's usually when I'm strolling. You probably are too if you're watching right now. And I saw this couple that was, I think the headline of the video was what we experienced our first year in retirement, something like that. And I thought, wow, that's fascinating. This couple retired and they're sort of doing this vlog or chronicling their experience in retirement. Now, here's the question. Did I watch the video? No, no, I didn't. It was 2 a.m. or something. I don't know. But that was interesting. And I thought, well, gosh, we should talk about that on the program. I mean, they're seeing it from their own eyes, and that's valuable. We have seen it. Our collective right here on the radio show, we've got 60 years of experience or more, and that's just Kevin.
We're pushing 70, my friend.
Yeah, it's a lot.
We're not young anymore.
And so, yes, Kevin,
I
heard you hesitate when you say thousands of families. It's maybe 5,000 families. Lots of families. We've helped them and watched them retire. And so from that experience, how can we help you know what surprises to expect and maybe avoid some of the unwanted surprises or just know ahead of time, plan ahead? So I've got a list we're going to start with of surprises. What are you going to say, Josh?
No, I'm excited about this show. I think this is a topic that is overdue. This is actually one of my favorite questions to ask new retirees, and I actually got to ask this question earlier this week.
So did I.
I didn't even know that we were going to be talking about this today, but
so I did.
They told me, I asked them, okay, first full year of retirement is under your belt. They had just moved to Florida, relocated to the sunshine and everything, and their comment was, well, it seems like calories still count in retirement. That was their first comment. And then their fear, this was a tax meeting, so they're like, I'm afraid that taxes still count too.
Okay, so that's a good segue. And yeah, calories still count, so that's not one of the surprises. But the first surprise that we've seen, is how important tax planning is in retirement. It is absolutely crucial. So guys, why is that a common surprise in retirement?
Well, I'd like to answer your question, but I'd like to ramble for just a little bit first. I had some preconceived notions about retirement when I started my career at 25, and not really knowing anything. And as you get into it, you learn. But you would think, well, tax planning is super important while you're working, and then you retire and you just hit the cruise control button and set it and forget it. Easy peasy.
Exactly.
And it's just not that way. It's actually the inverse of that. It seems to me, my experience has been, it's much easier to plan for taxes and do tax planning while you're working. Mm-hmm. And then when you retire, it's much more complicated. And because there are many more options, and you kind of have to figure out what is your theology of paying taxes. Because some people say, hey, I'm going to pay as much tax as I can in the lowest possible bracket and pay it now. And some people pay, I'm just going to get the smallest tax. The win for me is the smallest possible tax bill. And so the irony in that is the smallest possible tax bill can, in the end, be the largest possible tax bill.
Because it's
over your lifetime.
It's possible. That's right. It's possible that you find yourself in a very low tax situation early on in retirement, depending on how your assets are structured, and we'll talk about that in a moment. But then you've got this huge tax liability brewing with required minimum distributions that it's not like, well, I'll have to do that a year, or I'll have to do that for a couple years. No, you're going to have to do that for the rest of your life then.
Yep.
So you could enjoy a couple years of pretty low taxes, but then permanently face higher taxes. Go ahead.
Well, I want to go back to the comment that Kevin made about needing to figure out what is your philosophy on paying taxes, especially in retirement. And it's important to not only understand what your philosophy is, but the advisors that are helping guide you as well. I was talking to a brand new client this past week who part of the reason they were looking for a new financial advisor is because they had started a relationship with an investment guy at a bank, and they were pushing for, and we understand this approach, but they were pushing for every year trying to go harvest as many losses as possible in the portfolio. And his attitude, the client's attitude was, well, I don't really want to be harvesting tons of losses. I'm actually trying to increase my income to get to a certain threshold to, as you said, pay as much tax as I can in the lowest possible bracket. And so it's almost like the philosophies of the advisor and the client were not in alignment. They weren't trying to achieve the same thing. And they realized that, and then they started looking for a new advisor.
What's our philosophy? So what's ours? I mean, you should be paying the most tax at the lowest brackets, and with the goal of paying the lowest tax over your lifetime, possibly multiple lifetimes, even if that means voluntarily paying a little bit more tax today because you're in a low tax bracket. You should do some Roth conversions or capital gain harvesting, something like that. You've got to take a multi-year and in some cases, multi-generational approach to this. You have to.
Yeah, because the game is I have $1 in my retirement account, and it's going to be rendered something less than $1 after the tax man comes.
Right.
And I mean, to me, one of the greatest examples of this is you have older clients in Michigan, and they will come and they'll say, hey, I don't pay any taxes. This is great, but I've got this retirement account. And I'm like, well, look, here's the deal. You can pay a little bit of federal taxes and no state taxes on this retirement plan. Thanks, Governor Snyder. Because you are old enough.
Yeah.
The younger folks aren't going to get that benefit.
Right.
But here's the thing. If those people die with that money in their retirement account, their kids are going to pay federal and state taxes.
Within the Michigan state laws, and other states have some of these sorts of features, not all of them. I think it's birth year 1952 or 1950. I think 1952 and below, you're not paying state tax on withdrawals up to a certain amount from retirement accounts. But here's the big idea. We hit it earlier. Why is tax planning so important in retirement, and why is that a surprise? Number one, when you're working, when you have income, likely you think, I've got all this income and I'm, got to be aware of taxes. No, typically you're staying at the same job, you're making close to the same amount, and so there's not a lot of moving pieces. But in retirement, there's a lot of choice. The choice of, well, do I buy a new car this year and withdraw all that money or not? Do I withdraw from my IRA? Do I withdraw from my Roth IRA? Do I withdraw from cash? Do I do a Roth conversion? Do we take this big trip and pull extra money out of the account or not? I mean, how will my tax situation, my income influence my health insurance premiums, my Medicare? There's all sorts of choice and complication. And that's why you need to be working with a certified financial planner, doing tax planning and looking out multiple years. We're going to pick back up the idea of taxes being a surprise in retirement, but what are the other surprises in retirement you need to be aware of? We've got that and more coming up on The Wise Money Show with Korhorn Financial Group. Hello, YouTube. Thanks for being here. This is The Wise Money Show. You're at The Wise Money Show channel. What you're watching right now is our weekly 1-hour talk show. It's technically, I think, 45 minutes, 50 minutes, something like that. But it's long. It's long for YouTube because not only does it air here at 10 a.m. every Saturday morning, it's also on podcast, but it's also on a few local radio stations as well where we get the full hour. And so that's what you're watching. You get the bonus content at the breaks as well. All throughout the work week, though, we've got Next Wise Step videos that air Monday through Friday, and they take one financial concept, applying it directly to your financial life. So if you're trying to take a wise approach to your finances, trying to take a wise step in your finances, make sure you hit that subscribe button, turn on notifications, and if you like the content, leave questions, comments as well. We appreciate it. Gracias.
Yeah.
I still got it.
Aha, de nada. So I think what we might want to do is just talk to people about how we talked about tax planning, but this is a show about financial planning. So your tax planning has to incorporate really 5 of the 6 areas.
Yeah.
Because
that's how you'd know.
Or 6, but for sure I have to figure out what my income needs to be. Mm-hmm. So that's my present financial position.
You don't want to pay too much for your Medicare.
You don't want to be smacked by Irma, but you also, if you retire prior to 65, you need to figure out, can I manipulate my income low enough to get the advanced premium tax credit? You want to know investment-wise how to.
Well, we're gonna get there next.
Right.
That's the next.
And then
surprise.
that's retirement planning and estate planning, because who's going to eventually pay the tax on all this money? Mm-hmm. So I mean,
yeah,
someone needs.
Let's start with that.
Okay, who's going to start? Who's going to do it?
And again,
you just had your dress rehearsal.
Yeah, and not that we're not rushing.
This is real life, Josh. This is not a dress rehearsal.
And we're not rushing, but I want to make sure,
dude,
we're getting some variety.
Like we're not going to burn this entire segment on tax cleanup.
We would get boycotted if we were. I'm serious. Do you see how they're sanctioning all those people that are Russian?
Sheesh.
Okay.
Seriously, it's scary out there.
What are the biggest surprises that you're likely to face in retirement? How can you be aware of them, even plan ahead for them in advance? That's what we're helping you with right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name's Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on podcast wherever you listen. Go check it out. The weather's getting nicer. Throw those headphones in and go out for a walk or something like that. Listen to the Wise Money Show wherever you listen. Subscribe to the Wise Money Show and rate the program there as well. We appreciate that. Talking about equipping you and helping you be aware, anticipate the most common surprises that people face in retirement. The first one is how important tax planning is. You think it's on autopilot because I'm just going to draw Social Security and take a little money out of my investments. No, you've got lots of choice, okay? Truth is, it's more on autopilot while you're working. It's more complicated. You've got more options for tax planning in retirement. Kevin, give us some context here before we get into the next surprise.
Yeah, so this is a show about financial planning. And if you said, as we often ask folks, hey, who helps you with your tax planning? Most people do not get any help with their tax planning. They get tax preparation, but not tax planning. So you say, well, can we just do tax planning? You can't do tax planning in a vacuum, because if you're trying to maximize your tax situation, which means paying the most you can in taxes in the lowest possible bracket, one of the factors that goes into that is what kind of income do I need, and from which buckets do I take it from? Do I take it from my tax-free? Do I take it from my taxable? Do I incur capital gains in order to get income? So that really, to start out with, I need to know what my budget looks like. So I'm talking present financial position. That's my first area. The next area is protection planning. You say, well, what does protection planning have to do with any of this? Well, if you're before 65, you're going to need some type of health insurance. And if you're no longer working, you've got a couple choices. One is COBRA, where you're paying the employer's rate for the health insurance that you had while you were working. You can do that for 18 months. Another option is you can go to the exchange and get an Affordable Care Act or an Obamacare plan. And if you do that, your income matters.
Your income influences how much you pay and whether you get a discount or whether you're paying the full freight.
Big time. So that's where I need to manage how much do I need to have an income, and from what buckets does it come?
So that's protection planning, second area. Tax planning is the third area.
No. But wait, you missed the big one.
What's that?
The smack of IRMA.
Yeah.
So from 65 on, I have to manage my income below certain thresholds, because if it goes above those, I'll pay extra for my Medicare Part B.
Andy. Oh, yeah.
Say again?
Yep.
Yeah. So then I have tax planning, which we're already talking about, but investment planning, which you're trying to get to, which ties into retirement planning, and then I would say also estate planning, because there is the question: what's the least amount of tax I can pay over my lifetime, or over my beneficiary's lifetime? So those are the 6 areas that need to be factored in.
And I'm glad that you paused to talk about IRMA there, because this is one of the reasons why taxes or tax complexity is a surprise to people in retirement. There are some folks that don't realize that there are thresholds that you don't want to cross with your income.
Right.
And most people have some control over where you peg your income from year to year, at least on the tax return. And I've seen, unfortunately, some situations where it's often a second marriage where they're filing separate tax returns, and they don't realize that one of the spouse's income is creeping over one of these thresholds. And all of a sudden, they are getting clobbered with Medicare Part B. And this is not a small amount. I mean, this can be thousands of dollars in a year difference to get the same Part B coverage. You're not getting better health care.
Nope.
You're just paying more for it. So
Makes
IRMA
it feel
is
better.
IRMA is basically a means testing in a way for Medicare Part B premiums. So you got to watch this, and it's all based on your tax return, and you won't find out that you messed up often until 2 years later when those new Part B rates are being applied to you.
Because the prior year makes a ton of sense when you're figuring stuff out.
Right.
And this is another reason why you want to work with your certified financial planner, because we've had a number of folks that got the smackdown from IRMA, which is the income
related
monthly adjustment amount. There you go.
That's what I said. And so with that, they were surprised that, hey, this happened, but there is an appeals process, and we've had some folks successfully appeal. Now, we've had some folks unsuccessfully appeal, but I would say give it a shot.
Yeah. And so Kevin's laying out, and we've laid out the case that supports why every show we tell you that you've got to be working with a certified financial planner, CFP, that is doing comprehensive financial planning. Just working with an investment advisor is enough, even if that investment advisor has a CFP. If they're not going to look at all 6 areas of your financial life, they're not going to be able to help you understand of the choices you have, which are the great choices, okay? Because that can only come when you're looking at all 6 areas. Let's go into that next big surprise that people face in retirement, and it's realizing that their investment allocation needs to change, or realizing the adjustments they need to make in their investments because they're now retired. Now, I'll give you a quick example, and that is my father is an experienced investor and went through all the ups and downs and everything while he was working. Grew up poor, and first person in his family to really start saving and investing, all that sort of stuff. So had seen all sorts of markets, bear markets, blah, 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 okay? Gets into retirement. First bear market he sees, panics.
Yep.
Panics, because now I can't afford a loss like this. I can't. We're living off of this money, Mike. We can't afford to see the accounts go down this much, right? Yeah. It's a different perspective when you're in retirement.
For sure. And it is always that first bear market or that first market shakeup that does really test people's mettle, doesn't it?
Yep.
And you maybe felt like you were an aggressive, very growth-oriented investor as you were accumulating money during your working career. In fact, for 3 or 4 decades, you were in accumulation mode, and the ups and the downs of the market, they didn't mean as much to you. It didn't register emotionally like it maybe would in retirement. In fact, it actually benefited you during your working career. Those ups and those downs, they created buying opportunities for you, and it helped fuel some of your growth. But when you get to retirement and you're no longer contributing new money to take advantage of the dips, now all of a sudden, a bear market, a decline in the market of even 10%, feels like it's damaging to you.
Yeah.
And I've even observed that, yes, that first bear market and that panic that your dad apparently felt, it gets better with time because you're going to live through more of these bear markets. And, with clients that we've been helping for a lot of years in retirement, they've lived through multiple market cycles. They don't register quite the same amount of emotion deeper into retirement, thankfully, as you get used to it. And as you have a game plan. But as you said, your game plan has to be different when you're in retirement compared to the accumulation phase.
The bigger risk, while a lot of folks have that experience like my father did, again, that's just one example. It's common. It's very common. Brace yourself for that, okay? That you're going to look at bear markets even differently in retirement, especially that first one. But the mistake then that people make is, well, then once I get to retirement, I can't stomach that risk anymore, and therefore I've got to go no risk. And that is an enormous mistake because your retirement hopefully is going to last a couple of decades, meaning by the time you start drawing some of this money out, you're not drawing all of it out. A chunk of it is still long-term money. And so while that volatility, those ups and downs, Josh, were a benefit when you were contributing because you were buying more shares when prices were low, if you do the opposite, if you're selling investments, especially growth investments, every single month so that you can get your income, that's an enormous mistake because you're doing the exact opposite. You're selling more shares when prices go down. Got a little bit more to hit on this investment allocation surprise and then other retirement surprises that you're likely to face. We're helping you with that and more. This is the Wise Money Show with Korhorn Financial Group. Okay.
Yeah, that it is the internal finance piece, though. Because
the emotions.
Absolutely. Because people say, I used to have, 10 years, 20 years, 10 years, whatever, to work to make it up. I can't make it up anymore. I'm not going back to work.
Yeah.
And so there is a big, big, big internal finance emotional piece to this. And we are all hardwired to be horrible investors because what we do is we take the present and project it forward.
Right.
And if the market is down 10% this year, we're like, well, it's going to be down 40% this year because it's going to keep going down.
Right.
And what happens to my $1 million? Now I've got $600,000. Well, if it's $600,000, there's no way it's going to last me my lifetime. And then you just start spiraling.
Yep.
Yep. So, all right. Let's keep it going. We'll pick it back up. And then do we go into emotional challenges as the third one, or do you want to hit spending habits, how those change, and just go on schedule?
Yeah.
Go on schedule. Okay. And this is third segment. So,
Are we going to go into the fourth segment?
I'm sure.
Okay.
Yeah. This is a good topic.
Yeah.
So let's not handicap it for.
Do we want to say
WFRN.
anything else about like the surprises? Like one of the I've had a lot of folks that are really surprised at how difficult it is to change from the health insurance plan they've been on their whole life to Medicare.
Yeah, that's where I
understand. Like
that's good.
That is to me. If you said what's the emotional, like there's this emotional thing where I'm institutionalized because I've done the same thing for 40 years, and now I'm not. And so, well, how does that even change? Like, I can't play. Well, I could play pickleball all day, but not everyone could, right? And so it's like I can't play pickleball all day. I can't golf. I got I organize my sock drawer and my ties are organized. And like, what's next? I think one of the biggest surprise. So if you ask me two surprises.
Well, I've got it where we're gonna have it open. Like
do you,
we can.
Do you want me to surprise you with my surprises?
Yes, I do. Let's have it organic on the program.
I'm not surprised.
So.
I'm gonna go before you then to squeeze mine in case you
hey,
have the same answers.
I want to. I've got another comment to make.
Josh, my computer is hooked to your computer, and your camera's reading your notes to me right now.
I want to say one more comment about investments, and then we'll switch into spending habits, and we can hit that quickly, and then we can go into emotion, and we've got room.
Okay.
Third segment. What are the big surprises you're going to face in retirement? How can you plan ahead or at least be aware of them? That's what we're helping you with right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Stay up to date on all Wise Money content. Find us online, wisemoneyshow.com, and then all over social media, wherever you're at, we are there as well. All right, we're hitting the big surprises you're likely to face in retirement. What are those biggest surprises so you can plan ahead or at least anticipate them and hopefully avoid some mistakes connected to them? First one is how important tax planning is in retirement. The second one is how your investment allocation will likely need to change. Just a final comment on that before we go to the next one. The approach that you take climbing the mountain and saving and accumulating for investments, you've got to take a different approach on the way down. So here's what I mean. You still will have dollars that should be structured for the long term. You're not going to touch them for 10 years or more. But the dollars that you're going to be touching tomorrow or next month or next week, you've got to have in low risk so that as you're pulling dollars out to supplement your Social Security and pension, whatever, you're pulling those dollars out of low risk investments as opposed to having to sell higher risk investments, okay? This approach we call personal pension plan. Other people call it buckets of money. That's the approach that you should take. The approach that you should not take is a target date fund.
Yeah.
Or a balanced fund where you're just selling a little bit of everything every single month so that you can spend your dollars.
It's on autopilot, essentially,
Exactly.
right? It's not paying attention to the context or what's going on in the market. It may be a terrible time to be selling out of some bond investments or out of some stock investments, and yet there's just a pre-scheduled plan with some of those things. You may be selling at depressed prices and not even realize it's happening.
I mean, in retirement, you might say, well, I rode that target date fund all the way through my 401k savings. They said that it was going to adjust. Yeah, by the time you retire, you'll still have about 40 or 50% in the stock market. You might need more in the stock market, by the way, but you're having to sell 40 or 50% of stock market dollars every single month in order for you to get your income. This is a terrible idea.
Yeah, it's one of the reasons why the most important role in retirement that your advisor is going to play as it relates to your investments is helping you to kind of forecast what your needs are and finding the right timing to exit out of certain investments and raise cash so that you have the right amount of money in safekeeping when the needs arise and you're not going to that well at a time when maybe things are down. So I would encourage you, if you're not having regular meetings with your financial advisor in retirement and talking about how is cash flow feeling, what are the big ticket items that you hope to be purchasing or the big experiences or expenditures that you hope on the horizon, they need to be helping you plan ahead possibly years in advance for these types of things so that you don't back yourself into a corner and have to sell something at a low price, or you have to pull more money out of a taxable investment in 1 year and trigger a bunch of adverse tax effects, right?
Yeah.
So the planning ahead and just the steady rhythm of taking the right withdrawals at the right time, that is the role that they could be playing in retirement for you.
Absolutely. And that's a great segue. The third surprise, we're going to hit it more like an honorable mention. Don't want to spend too much time on it, but that is how your spending habits change. Kevin has a saying that when you retire, it's 6 Saturdays and a Sunday. That's what it's like. Well, I don't know about you while you're working. I spend more money on Saturdays than I do on Tuesdays. Why? Because Tuesday I'm at work all day and I'm hustling and so when I'm get done from work, I'm rushing out to baseball games or whatever. On Saturdays, I'm looking for entertainment. We're going shopping or we're going to a movie or we're doing something. And when you've got more choice with how you spend your time, you're likely to spend more dollars. So that's one, why your spending habits change in retirement. And two, Josh, you already sort of hit it with in the investment context, which again is another reason why you need a comprehensive approach to your finances, is when you've got big ticket items, buying a vehicle, doing a house change, doing a house improvement, doing a big vacation, you can't just fund that from a bonus anymore or something like that. You've got to look at, well, which accounts am I going to pull that money out of? Which investments will I pull that money from? What tax consequence will there be? All of these sorts of things need to get factored in, and that influences your retirement spending.
But the big difference is in retirement, and I'm fond of saying this. It's not perfectly true, but it illustrates the idea is that when you're working, you have money and no time, and when you're retired, you have time and no money. Now, neither one of those are true, but that's the idea. And so, Mike, what you're talking about is planning, and you actually have time in retirement to think and consider and measure twice or 3 times or 4 times to say, hey, what are the expenses that I'm going to have? And it's kind of fun watching people retire because I tell them, look, the first 18 months are going to be different than the rest of your retirement.
Oh, totally.
So there's all kinds of different changes and adjustments and things. And then people start saying, okay, well, and it's fun to watch the wives who have wanted the bathroom to be remodeled for the last 25 years, and she finally convinces her husband to do the $30,000 bathroom remodel, and it kills him, but he's so happy when it's done.
Right.
And you just watch this process, and you're like, yeah. And they fix the bathroom, then they fix the kitchen, and then they have new washer and dryer and new vehicles, and it is like they get everything kind of ready to kind of finish the last leg of the journey.
And you know what? I'd point that out as sometimes a potential mistake. If while you're working, you're pinching pennies and all this stuff, and you're just creating this huge to-do list, and then all of a sudden you retire and you transition into this, okay, I don't have a paycheck coming in anymore, but my CFP has run the miles and they've said I can get enough money, blah, blah, blah. But wait a second. Now we've got $80,000 of projects, of pent-up projects that we never did, and you're going to feel a little nervous about that. Mm-hmm. So that's a good lesson to maybe consider doing some of that stuff along the way.
We talked earlier in one of the segments about IRMA and how if you take your income too high, you can trigger higher expenses for Medicare Part B premiums and everything. It's often these types of projects that will trigger someone to suddenly have a really high income year, and they don't realize that they're causing expenses 2 years down the road in their health insurance. So yes, even big ticket items, whether it's a home remodel or a car replacement or a big, huge trip you've always wanted to take, those types of things, those have to be worked into your retirement plan.
Yeah.
It has to be part of your investment game plan to harvest money at the right time for those things.
Interwoven into all of these surprises we've talked about, and the other ones that we'll add on here in a minute, is the fourth surprise, and that is just the emotional challenges that you're going to face in retirement. And it could be, oh, I'm stepped away from that paycheck and now I'm just drawing out of the money that I had saved up, and that makes me nervous. It could be one spouse was already home and now the other spouse is crowding my space. Are we compatible still? Or I don't know how I can spend so much time with this person, right? There's those sorts of emotions. The emotions of, I felt a sense of accomplishment while I was at work.
Yeah.
Mm-hmm. And I'm getting stuff done. I'm being productive and I'm valued. And now I've stepped away from that. Mm-hmm. Lots of emotions coming into play.
It's a major life stressor for people to go into retirement. And you might say, well, how in the world can that be stressful? Shouldn't that be like stress coming off your shoulders? This is a brand new life that you're walking into. No, you are leaving behind some good things with that job.
Yeah.
Maybe it is just the social aspect or the fulfilling work that you were doing and everything. And yeah, it was stressful and maybe even having some health effects for you, but there was good that came from it too. And it is one of the reasons why a lot of people, they genuinely go through a phase of depression or maybe anxiety, stress, even though they're stepping towards something that they've been building for a long time and finally have hold of it.
I would say probably 50% of folks have some negative emotions after they retire. They think it's just going to be blissful, but they're surprised that, oh gosh, I missed something or I didn't expect this. Emotionally, there's some struggle. There's some struggle there. So a couple more surprises we're going to help point out so that you are aware and can plan ahead for your retirement. So that and more coming up on the Wise Money Show with Korhorn Financial Group. Okay.
Good stuff.
Good. Yep.
So Josh, just a small amount of bonus content. We're talking about that pent up demand. I think this can happen. Typically, like you don't want to spend while you're working. And then all of a sudden it's like we retire, and you're going to get this with your spouse, especially if one spouse has said, let's do these things, and one has said, let's hold off, is the spouse who says, let's do these things will say this. Well, we're retired. We've saved up. We've prepared to do this. Let's do these things now. Isn't that what this has all been about? And I'll just tell you right now, I'll warn you, there's no counter argument to that. Like they got you. Once they say that, they got you. So then all of a sudden you're having to spend all of this money to do all these projects that you had put on the back burner, and that creates these other problems. But here's what I would point out. Josh did a whole bunch of thinking. This is a long, long time ago. Some great work on the 7 transitions that you'll face in your financial life. And this just reminds me of the importance of that empty nester stage. Mm-hmm. If that empty nester stage, you start coasting or you take your eye off the ball and all of a sudden you just start sort of, well, we'll do this later, we'll do this later, we'll do this later. And you don't maximize that time, you could use that time to make a list of these projects. And so say, okay, we've got 7 of these projects. I think we can tackle 3 of them over these next 6 or 7 years before we retire, something like that. Mm-hmm. Using that stage, that transition into empty nester before that transition to retirement.
Yep. The argument I hear a lot is, well, now is when we're young and healthy.
Correct.
So now is when we need to be on the go. Let's go do the trips and everything. And those couples who temper that with still a recognition of what's going on in the market or what's happening with their investments. Do they have the cash on hand? Is this a good year or a bad year to do something like that? They tend to be folks who recognize that retirement is a marathon, not a sprint. You don't have to get it all done in the first 2 years.
Although
right?
I would agree. I mean, Kevin, the first 18 months of retirement typically look very different.
Yep. Mm-hmm. And that's part of the reason why a bear market right at the beginning of retirement is dangerous, because people lock themselves into certain spending commitments or projects or whatever, and they're spending it whether the market's cooperating or not.
Yeah.
So.
All right. So for a segment, let's just either double back on some of these, or it sounds like you guys have some fantastic additional surprises. So we'll just have sort of an open dialogue about that. So, all right. Thanks for being here. This is the Wise Money Show with Korhorn Financial Group. My name's Mike Bernard. With me in the KFT studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show, and as well as a lot of other content, is on the Wise Money YouTube channel. Go to YouTube, search the Wise Money Show, subscribe to it, turn on notifications, because we drop a lot of content there, lots of great ideas to help you take your next wise step in your financial life. And then when you're there, submit comments as well. We appreciate that. Give likes, thumbs up. We appreciate that as well. All right, so we're talking about what are the biggest surprises that you're going to face in retirement, so that you're aware of them, so they don't catch you off guard, or they don't, more importantly, create some mistakes, force you into some mistakes. And maybe you can plan ahead by having this foreknowledge, forethought as well. So we've hit the big 4. Tax planning's going to be even more important in retirement. That's one. Your investment allocation, your investment decisions will need to adjust in retirement, and not just in the normal, well, I'll take less risk. No, your approach will need to change. Your spending habits will change. It will look different. You need to be more planful of your spending. There you go, Kevin. And then you're going to face a lot of emotions. And honestly, guys, I would have started with that one. I would have.
The planful approach?
No.
Or what?
The emotions
okay.
in retirement. I think that is the biggest surprise, but, I'm a financial geek, so I want to talk about the numbers first. What other surprises? What are the other big retirement surprises that we haven't talked about yet?
It's different for every client, so it's tricky, because you're like, well, this, if I was going to create the composite retiree, this is kind of what it would look like. And so the composite retiree typically is surprised by how complicated medical insurance is after they retire, because they're used to doing it a certain way for 40 years. And then now I'm either on the exchange or I'm on Medicare, and it's just different. And your cognitive ability, and I can say this as the old guy in the room, your cognitive ability just declines gradually over time. And so most people, once they turn 65, aren't super pumped about, hey, change how everything works.
Right.
And that's really with your medical situation, that's what happens.
And it's also coming at a time where you might need to visit the doctor more. And
Sure.
so you're going to potentially use the insurance more, and guess what? It's not going to look and feel anything like what you've had your entire life. Yeah, it's huge. I mean, that's crazy.
That has changed, because it used to be, when I started in the business 28 years ago, the idea was, hey, listen, you're going to have to work until you are 63 and a half. You can go on COBRA for 18 months and then get on Medicare, because no one's going to insure you. Well, it's different now. You can get insurance. And so this is where your protection planning piece of the 6 areas of financial planning becomes much more important, because protection planning impacts your present financial position and how much you're spending, either on insurance premiums or actually doctor bills. It impacts your tax planning. It impacts your investment planning. All of these areas get impacted by your health insurance. You're like, no, how can that be? Yeah, it is that way. And another surprise, and I'm going before Joshua, so he doesn't take mine. But I think people are surprised at how busy they are in retirement. Because, Mike, you said, well, can we get along because we're going to be spending all this time together? People actually have a lot of fun, and they are surprised at how much they enjoy being together, and like, oh, that's right. This is why we got married a long time ago. Yeah. So
it's fun to find those spouses that they discover a new hobby that they enjoy together.
Yes.
Maybe neither of them were ever golfers, and now all of a sudden they start golfing together with other couples, and it's a thing they enjoy together. Mm-hmm. Retirement can make that possible.
Yeah. So most people are surprised at how busy they are, and almost to a client, there is a life event that happens shortly after they retire that they can attend to that they would not have been able to attend to had they been working. And it's
all right, you're creeping into my notes here now.
I know, well, dude, but I mean, this is what we see over and over and over again. And I don't fully understand it, but it is typically related to family, typically related to health, whether it's their own health, their spouse's health, their folks, their children, something. And they are able to step up in a way that they could never do while they're working.
Yes.
And it's very soulful. It's very satisfying for them to be able to play a role that they've had to watch others play up to this point.
Yep. And that's one of the reasons why, throughout your working career, you're working with your certified financial planner, you have this vision for what you want retirement to look like, you're preparing for it, accumulating all the sacrifice that goes into it, and then you get to retirement and it looks different than what you thought. And it could be the health of an elderly parent. Mm-hmm. Or it could be your spouse who has an injury and it takes a long time to recover from, whatever that is. So I think it's important that you go into retirement and you hold it with an open hand and that you remain flexible and pliable. Recognize that when you think of retirement, you think of it as this long just era or a stage in life, but it's really a whole bunch of different stages along the way. Mm-hmm. Yeah, there's going to be some years where your health is great, both of you, and you can go travel and do projects and things like that. There may be some years, as Kevin, you were saying, hey, you're staying close to home because you have a parent or some other dependent that's coming to live with you for a while. That stage isn't going to last forever, and you're going to miss it when it's gone.
Can I interrupt for 1 second?
Please.
So here, I want to be careful about how we talk, because we never want to come across as condescending or demeaning or anything like this. But I've had folks that have stayed close to home for a senior dog. I don't know what you would call it, but an aging dog. Mm-hmm. And they're like, we can't go because we can't leave our dog, and our dog, I was talking with some folks, and they said, hey, we left our dog at the kennel one time, and all his hair fell out. And so we're not going to leave our dog at the kennel. So, I mean, you would be surprised what it is that keeps you off the road.
Yeah.
But I mean, it's real. So I'm not cracking on anyone if they're saying, hey, I can't go because I got to take care of my pet. Like that is a real thing, and I've seen people in that situation.
It is a surprise to people because that was never a discussion, right? When they were planning for retirement and accumulating and stuff, I need to set aside money for a pet or whatever. But that's kind of the point, is you don't have to get it all done in one year for those positive, fun things, but also recognize there may be some interruptions to your life on the go. there may be the pause button that you have to hit at times. And if you can choose to find the joy in each of those stages or each of those years, those are the clients that I observe who have the most fulfilling retirement because they're kind of going with the flow a little bit. They are taking an optimistic view on the world and on their situation. Like you said earlier, Kevin, one person might look at the caring for a family member and all of the constraints it puts on their schedule and feel like they're missing out. Others might feel like, wow, thank goodness I'm not working because I can be the help that this person needs. And it's all about perspective.
I would add to that, while you guys are thinking of it, any other surprises to prepare folks for, I would add to that, sometimes caring for, needing the flexibility in your life to attend to a family matter or care for a family member, that might be the reason retirement is accelerated a year or two.
Yep.
And I would just point that out as we're talking about retirement surprises, to point that out as a retirement planning surprise as well. You might need to retire a year or two sooner than you expected, and that might require some other trade-offs. So make sure that you're doing what's necessary to prepare, stay on track, know whether you're on track, stay on track, or even get ahead, because you don't know. Was having this very conversation with someone earlier this week where she said, yeah, mom's health is failing, and I'm hoping to retire in 2 years, but I might need to retire sooner than that and go help her. And I was thankfully in a position to say, well, we're doing comprehensive financial planning, so I can tell you exactly where you stand, and you were able to adjust if you need to.
Right.
But planning for retirement and when you're 2 years out, because Josh would point to statistics and say, hey, statistically, you're going to retire sooner than you thought.
Yep.
But it's planning for retirement is kind of like statistics class was in college. Like, you can't get to the end of the semester and cram. Like, if you get to the end of the semester and you're unprepared for your statistics final exam, it will be a nightmare.
Reflected in your grade.
That's what I've been told. Anyways.
All right. What other surprises do people face in retirement? I'm thinking of one. The house change, the downsize, typically isn't a reduction in cost.
Yeah.
And there's some folks that are banking and planning their retirement finances on, well, we'll be able to sell the house for $300,000 and buy the next house for $150,000. No, you're not. I mean, I can't. I wouldn't have said that so confidently a year ago, but I'm going to say that very confidently now. Those smaller houses, ranch style houses, less maintenance, bedroom all on one level, that are desirable in retirement, they're going at a premium. And by the way, they always were. And so, I would say be aware of that as you plan ahead. I don't see many that are downsizing to a smaller price.
Yep, you're exactly right. I'll call this one more of a public service announcement than anything, but a lot of retirees have to make an adjustment in how they pay their taxes, and they start making quarterly estimates, and that is a learned skill. You need to have a system in place in order to get that one right, because it turns out the government doesn't spread those payments out, or doesn't want you to spread them out evenly throughout the year. You go from April 15th to June 15th, and it seems like every year there's someone who misses that memo.
Yeah.
And, again, it's kind of a silly one, but not realizing that you play a more active role in the payment of your taxes, the planning of your taxes. We had an entire segment or two earlier in the show about that. But don't be caught off guard on even just the mechanics of your tax picture.
Absolutely.
Yeah, and I would encourage you, if you don't like paying estimates, because for most folks, the last thing they want to think about is, did I pay my estimates?
Right.
And if you've ever been in that program, I've put the right check in the wrong envelope. It's so simple and so easily screwed up, it's unbelievable. Mm-hmm. So what we try to encourage folks to do is to figure out a way to pay your taxes at the end of the year out of your retirement plans. Now, that's going to take some planning, but it can work.
All right. Another one, Social Security could be taxable, and the amount that it is taxable varies. So be planful. The whole idea, take a comprehensive approach to your financial life. That's all the time we have. On behalf of Josh Gregory, Kevin Korhorn, and all of us at KFG, have a great weekend. We'll see you next Saturday for the Wise Money Show with Korhorn Financial Group. I don't know why that just stands out.
I cannot take it. I have such an emotional response.
So offended.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.